Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning with your money for your investment, retirement, financial future. He is president and founder of Mcintire Retirement Services. Chris Mcintire here with us, providing guidance and perspective on the financial world. And Chris, so glad you are, because I think that's one of the challenges in today's financial world is sorting through all the noise and figuring out where we can have a reliable source for financial information. It just seems to be getting more difficult every day.
Yeah, it sure does, Peter. And, I guess you can kind of call it the conflicts of both sides of our industry, the fiduciary side versus the suitability side. And we obviously fall on the fiduciary side of things there. And, there's so much, let's call it misinformation, whether it be social media or, some intended bias on certain advertising pieces that you'll hear that, it's like, look, lay out the facts, tell people what's the good and the bad of everything that's available to them and help guide them to making a clear decision. That's not rocket science. And, tell them how you get compensated. Are there any conflicts of interest? Are you qualifying for a trip to Disney World, or are you truly, earning a fee from the client to give unbiased advice?
And it does seem like there is a lot of back and forth in those discussions, Chris. And I mean, there's a whole host of entities out there that are trying to separate us from our money to the extent of fraud, even, and identity theft. Those are kind of the extreme examples. But I think that more subtly, what people need to know and understand are the minutia of the financial world. What are those different compensation models? Where can there potentially be conflict created? Where are there things that we are hearing or seeing or relying upon in our planning that may or may not hold true? So digging into a few of those financial conflicts on today's program to try to add some clarity for you, ladies and gentlemen, that will be the theme of today's program with Chris Mcintire. And if you need clarity on your own situation, you are always welcome to call Chris directly, have a conversation about your money, about your financial goals, and how each and every dollar is working to help you achieve them. If you would like to have a comprehensive planning review, Chris offers that as well. Complimentary, no cost, no obligation. Just give a call, set up a convenient time for you. One of his offices across Northwestern Ohio, 800-868-1194, the number to call. That's 800-868-1194, 800-868-1194. Chris, I think that there's good information out there that if taken out of context, if misapplied, if it doesn't pertain specifically to our situation, can still lead us astray. And that's one of those kind of subtle financial conflicts I'm talking about here. Do you see and hear that on the news media and in the headlines and from the talking heads?
Yeah, no question about it, Peter. If you're watching CNBC or whatever business channel you're into, they're really focusing on, a lot of individual stocks. So your bias is toward, having all your money in the stock market, or, what are government bonds doing today? And you've heard yield inversions and, lots of fancy, terminology, almost to, I don't want to say they're trying to deceive people, but how many people understand what a yield curve inversion is, and that are listening to our radio show today, and how many of them care in all reality? They want to ensure that, their nest egg has probably some sort of degree of protection to it from, the way the market has performed this year. We broke that 20% barrier in a bear market on the S&P 500. The NASDAQ, more technology driven, is even worse than that. So, how do you, kind of guide your way through, some of the bias on, well, this guy said this, I turned the channel, this guy said that, and there's 10 different people can do it 10 different directions. And, you and I have said on this show for how long that, look, it's not always that if you if you don't do it this way, everything is wrong. And that's not the case in the financial world. We have conservative investors that don't like to be in any individual stocks whatsoever. They want to be incredibly conservative. We have folks that want to be incredibly aggressive. So, we deal with a myriad of different types of portfolios, of different types of platforms, of different types of investments, made up of different types of investment products, from stocks to bonds to exchange traded funds to mutual funds, the annuity space, all of that, the cash value life insurance side of things, so there are, it's like, why do you have a bias? Why don't you go in with an open mind if you're advising clients? What are the good, the bad, in the ugly of all the different aspects that they have to put their where they can put a piece or all of their nest egg.
When we watch the news or read the headlines, Chris, we have to understand that their job is to gather viewers, to keep us on the edge of our seat, so to speak, to retain viewership. I heard recently and several times, but it was reiterated to me recently that if there is no product being sold, then you are the product. And when we watch the news, that's what we have to realize, is that they are gathering viewers, eyeballs, and eardrums to be able to sell those ads to us. We are, in fact, the product there. And I think that because of that, the American public is sort of beginning to realize, hopefully, that this is not the news of the 1960s and 70s where the anchorman just presents the facts and leaves it up to you to draw your own conclusion. We have to kind of look at everything and listen to everything with a bit of skepticism and jaded glasses, and then do some additional research to draw our own reasonable conclusions about what we're hearing, what we're seeing. And I think that is especially true when it comes to the information that we're hearing on the direction that we should take with our money. A lot of people out there claiming to know the future, claiming to know what the next best stock pick is, but we really have to do our own research there.
Yeah, you're right, Peter. It's very hard to predict or time the market, obviously, is probably a better, more accurate description. Are we at the bottom now? Is inflation going to rear its head again later on this year? And, that's why you build portfolios around your overall risk tolerance so that you can avoid making emotional decisions. We advocate for having a safe money strategy where you don't have that direct stock market exposure. And, that way for your investments that are directly invested in stocks and bonds. And this has been an awful year for bond performance, obviously, with rising interest rates. That's pushed down, even the conservative investors down over 10% this year in a lot of types of portfolios on the bond side of things. So,
yeah,
having the ability,
subtle financial conflict there is that what was considered safer or more conservative is actually lost a pretty significant amount of value in perspective.
Yeah, you're exactly right. And Peter, we do a lot of safe money type things. And, we highlight the risk you have with bonds, and that would be interest rate risk, right? When interest rates go up, it pushes bond prices down. So, but you have to realize that, all right, once we get through the interest rate cycle, those bond prices typically come back up to what we call par or their face value or close to it anyway. And, but along the way, they're still paying interest payments. And if you're reinvesting those interest rate payments, then you're buying, stocks and bonds at lower prices as you reinvest. So, some of these things, we have this immediate mindset in today's society where I want immediate results right now. Well, in stock and bond performance, that, what we're seeing today you might be buying future higher rates of return down the road, especially for people that are putting money to work right now and buying investments that are down in value. That might not pay off for 3 or 5 years down the road, but it could pay off very well for you as the markets recover.
But you got to have that long-term time frame and perspective. If you think that company is going to be around and profitable in 5 or 10 years, right now, you may be able to purchase that company at a 25 to 50% discount. If you were happy buying it at the highs of last year's prices, why would you not be happy buying that same company if you think it's going to be around and in business and profitable in 5 or 10 years? That's the kind of long-term outlook that you need to have with those at-risk investments. But there are also safe money strategies, as Chris Mcintire talked about, and having that balance in your portfolio is important. If you'd like to talk with Chris about those options, explore the different alternatives that you have for achieving different goals with your money, long-term growth, short-term safety and preservation, income throughout retirement. There are different options, strategies, and structures for the portfolio to achieve those goals. And maybe a mix of all of the above is the right mix for you, but you've got to get specific, individual, custom catered advice. And you want to have that from a fiduciary to eliminate as many of the potential conflicts of interest as possible. Fiduciary, ladies and gentlemen, an important terminology. We'll talk about that a little bit later in the program, but it basically means having your best interest in mind when recommendations are crafted and given. And Chris Mcintire is an independent fiduciary advisor, does offer his time for a conversation or a consultation, no cost, no obligation. Just give a call, 800-868-1194. That's 800-868-1194. Chris, another subtle conflict. We talked about how no one knows the future, but the reliance on the past when we talk about investment performance. And yet there's a standard mantra in the financial world. The saying goes, past performance is no guarantee, or maybe not even an indicator of future results. And yet so often I hear predictions of the future being made based upon that past performance. Is that just the best that we have, or is there an inherent conflict there that we need to know and understand?
Well, and some people call that yield chasing in a lot of ways. I want to chase this hot fund. This fund did 30% last year, so let's put money into that. And so sometimes we call that yield chasing, where we're just looking at the, at the top performers of last year, and we're just going to chase them down. And so we're, instead of having some sort of long-term strategy that says, hey, I'm going to use a number of different types of financial instruments to help me achieve my goals, and of course you want to rebalance, and you can adjust your sales to steer your, to guide your ship through this retirement, on this retirement course, if you will, trying to make a lake adjustment with a sailboat in the background for those of you that watch our podcast here. But Peter, I think, one of the biggest things that people need to understand as they go through this is, look, the markets are going through different cycles right now, for sure. The inflation side is really, upset the bond markets, upset the stock market. And there are a lot of large companies, small companies, medium-sized companies that are, an incredible value right now. They have really sold off more so than what they have. So we have been looking more toward utilizing value type stocks versus growth type stocks. And, previous to this recent sell-off, we were in a very strong growth market, meaning Amazon, for example, Microsoft, some of those, a lot of that technology, Zoom, some of those companies that got us through the pandemic, allowing us to work from home, were growth type companies. And now we're seeing a pretty good shift here where there's opportunity in value type stocks that have been beaten up pretty good here and are, a bargain to buy. So, when we say, chasing a fund's previous performance, we look at things from an economic standpoint to, okay, where is the opportunity right now? Not how did they do last year, but what does next year look like, for example?
You've got to understand that things are cyclical. Different assets will perform differently under different circumstances. Chris, there's an old saying in the investment world that history does not repeat, but it often rhymes. And I think that we are seeing a bit of that rhyming right now. Conditions today, very similar, although some differences, some notable distinctions between today and the inflation and the interest rate and the stock market direction of the late 1970s, early 1980s. The Fed and the government took about the same approach when inflation started to get away from them, and the stock market actually had a pretty similar kind of reaction to that approach.
Yeah, it certainly did, Peter. I like your analogy there. History doesn't repeat itself, but it often rhymes. We're kind of seeing housing prices increase quite dramatically here. And, I think the Federal Reserve is going to get ahead of that game so we don't create another bubble there, right? Because, healthy markets correct, but bubbles burst. So, trying to, understand where we're going with some of these things. Why is the Federal Reserve raising rates so fast? And, I was listening to a gentleman on the business channel here this week, and he was talking about, the Fed might have to start slowing down because some of the indicators that we see, have already happened. For example, what was the inflation rate in June? Well, heck, here we are later in July, working our way into August. We need to know what are the current or the leading indicators. And, so there are leading indicators, lagging indicators. And, the Federal Reserve's got a tough job here to help us get through some of these waters, that if we tip into a recession, that it's not a very steep one, if you will.
Yeah, a lot of those terms, Chris, inflation, when we have seen it, bear market, recession, they are historical in nature. By the time we're in that condition or we are hearing that title, it has actually already happened. We're already there. And then we may begin to move a different direction once we're hearing those. Now, nobody, again, knows the future, but we've got to have our plan prepared regardless of market conditions. And once we're hearing those kind of terms, we probably have already seen some of the results and impact is the gotcha of all of that. So again, if you have questions, concerns about your money, your finances, if you want to make sure that your plan is something that you can count and rely on, and that you understand the ins, the outs, the benefits, the disadvantages, and where there are potential opportunities, even amongst down market conditions, opportunities when things are not always moving in a positive direction. There are those out there, ladies and gentlemen, if you are properly positioned and have a plan ahead of time. Pick up the phone, give Chris Mcintire a call, 800-868-1194. That's 800-868-1194. Now, Chris, during times of market flux, a lot of people do look for safety. They don't want to stomach, can't take the risk, and so put money in the banks. We're told we should save money, in fact. But the irony of that, the potential financial conflict, to stick with a bit of the theme of the program, is that banks themselves don't often save money. You think of making a deposit in the bank, and the bank takes your cash and puts it in a locker room safe in the back. But that cash to a bank is actually a liability. A liability is something that costs you money. An asset is something that gains you money. So if that cash just sits there in the bank, that is a liability to the bank. So when the bank tells us to save money, they're actually doing something quite the opposite with that money. Is that an inherent financial conflict that we need to understand and be aware of in order to make financial gains and progress?
There's an analogy or an acronym. It starts with OPM, other people's money. And how do banks make money? Well, you make a deposit and they loan that money back out to somebody else, and they take the risk that they're going to pay it back. And so, yeah, I suppose we could say that, and Peter, a lot of the banks have gotten into, the financial services industries, and they have some, I suppose if you peel back the layer of the onion, you would probably find some conflicts that, hey, they've struck up a relationship with XYZ company to, compensate their financial representatives to shift money in there. And I've had on more than one occasion where clients will walk in and said, yeah, every time I go into the bank, they keep saying, well, you got way too much money here in your savings account. You need to go talk to, the broker over here, and he could show you how you could make more money with that. So
yeah, I think they have an alarm bell that goes off once your balance hits a certain level that they start saying that to you every time you walk in, Chris.
Yeah, absolutely. I've had a number of clients say that. And even I do when I walk into the bank. My wife handles most of our banking stuff online, so we're not too much in there face to face. But every once in a while, I'll walk in there like, boy, you got Mr. Mcintire, you got a lot of money sitting in your checking account there. Is there anything else we can help you with? And I'm like, nope, got it covered. And, obviously they don't know what I do for a living, of course, but I've had a number of clients, even one that some folks I met with several years ago, Peter, probably going back 6-7 years ago. And I was doing a public speaking event, and a lady actually raised her hand. She said, I work for a bank here, and this is in the Toledo market area, and said they put so much pressure on us bank tellers to make referrals to the financial officer at the bank so that they could sell products for commissions that she quit her job. She's like, I don't want to work here and just refer people. It's not, I want to service the clients and not necessarily just be a referral machine to, and so when you speak of conflicts, that could certainly represent one right there.
Yeah.
You got too much money in here. You need to go talk to XYZ. He can earn a big fat commission and I get a referral fee. That's the conflict I think we're trying to outline, buddy.
Not to say that banks are wrong or unnecessary. Banks are absolutely necessary and very valuable, but you've got to understand the limits and limitations on savings accounts at banks, checking, savings, money markets, CDs. Long term, you are losing money to inflation, and we are encouraged to save money in the bank, but the bank, in essence, turns around and does the exact opposite. Once we do save that money, it's a liability to them. They want to turn it into an asset. So they want to get that money out of the bank, loan it out, invest it as quick as possible. Just kind of a behind the scenes inherent conflict in the financial world that we are talking about today and exploring some of these items. Another one, Chris, buy and hold. We're told that we should just buy and invest for the long haul. And in certain cases, that is probably appropriate. We already spoke about the fact that we should have a long-term outlook and time horizon with our investments. However, mutual funds in particular often are doing the exact opposite. If you look behind the scenes, if you scratch beneath the surface, there's something called an internal turnover ratio. And we're told to buy and hold those mutual funds long-term in our 401k or our investment account. But if you look at the internal turnover ratio for many mutual funds, it can be 50%, 100%, 200% or more in any given year. What does that mean, Chris? And is that an inherent conflict that people need to be aware of when investing their money?
Yeah, certainly does. If we look at like an index mutual fund of the S&P 500, we don't have the turnover there, right? That's an index fund, very tax efficient there, and it just mirrors the companies that are in the S&P 500. But if you have some other more actively managed funds in there, then those aren't buy and hold strategies. If you own those types of accounts outside of your IRA, you could be spinning off a ton of capital gains taxes and dividends and things like that passive in you're paying tax on money you're not spending, basically, right? Passive income, passive taxes on some of those instruments. So you need to know what funds you own. Is there a lot of turnover in there? And I think if you take a look at a lot of the bond funds, all the turnover that are in bond funds sometimes can be very alarming as well. So
even if you're just holding that position inside of that position in the mutual fund or bond fund, there are transactions happening. That's the turnover ratio that can create taxable events. And Chris, a good segue there, as you mentioned, taxes with those kind of accounts. That's another place where we've got to have a fundamental understanding. And the language in the financial world is often that you should specifically consult a tax or legal professional, because the financial recommendations are not tax or legal recommendations, don't include that as part of the recommendation. But every financial recommendation, every financial move has some tax implications. So therefore, when that statement is made, it does seem to be a bit of an inherent conflict. And you're a self-proclaimed tax geek, so you have a pretty good understanding of those tax implications of various financial moves, maneuvers, and strategies.
Peter, we had a listener to the radio show came in and we did kind of an overview, and she brought her income tax statement in, and I looked at like qualified dividends and the capital gains taxes, and I'm like, well, you had a pretty substantial capital gains tax here. What happened? They said, well, my advisor said I had to switch over to a different account. They had more of a fee-based program going, and I had to move my money into that program from where it was previously. I'm like, well, did he pay your capital gains tax bill for making that recommendation? Because it clearly wasn't in your best interest to do that. Why pay a huge capital gains tax so he can earn a fee? And, it just sometimes the income tax statement tells the story, and, like this year, for example, we're looking at clients that have non-IRA assets with us. And do we sell some of those positions they have that are at losses to have a capital loss that we can carry forward to offset for future capital gains? So, sometimes you want to harvest some of your losses to offset future gains. And that's just what an advisor who's on his toes is paying attention to. Look, I can sell a Fidelity mutual fund at a loss and buy the same fund over at Vanguard, I've recovered I've made the transaction and I've locked in a loss to go forward, to offset a future potential capital gains. That's just being on your toes there.
Another tax implication that can be an inherent conflict, and this is more of a self-conflict, is paying taxes early, Chris, on those retirement accounts. I know that you have been talking about, and we've had entire programs that are centered around Roth conversions. Now, this conflict is one where there's a little bit of pain in this consideration, and it's not for everybody in every situation. You've got to weigh the costs and benefits carefully. But Chris, that little bit of pain up front may create a great opportunity for more tax-free dollars down the road. And that's a conversation that probably needs to be had more often. In fact, if it has not been at least approached and addressed, that may be an indicator or a red flag that there may be something missing and your plan may not be complete, or the conversation at least has not been a complete conversation about your financial progress.
Yeah, you're absolutely right, Peter. So for example, let's say let's just use Amazon stock as a generic example here. And let's say it's down 30% this year in value and you own it in your IRA. You could take that Amazon stock, move it into your Roth IRA. Yes, you have to pay tax on the amount that you would convert. So you certainly want to talk with your tax professional ahead of making any of those moves. And then once it's in the Roth account, let's assume it recovers and performs very nicely over the time horizon. Well, you converted it into a tax-free investment at a 30% discount from where it had been trading at had you done it on January 1st. So, you want to know where your tax situation is, and then that helps determine how much you can convert to stay in the same tax bracket you're in, without going into the next one, for example, like going from the 12% tax bracket into the 22% tax bracket as an example.
Chris, just for the sake of time, we're not going to be able to get to many of the additional items that you had on your list of inherent conflicts or issues in the financial world. Kind of laundry listing them off here. The compensation costs and commissions are something may not present a conflict, but you need to be aware of. And unfortunately, too many people aren't. Misleading advertising. There's an ad out there in particular that right off the gate, it tries to create a false sense of distinction and differentiation that does not truly exist. And we've had problems with that. The different compensation models, past performance and average rates of return, and then out and out fraud and identity theft, something that people always need to be vigilant and protect against. Chris, a surprising statistic there on one hand, actually maybe not so surprising, is that seniors are those most often falling victim to fraud. But the surprising part of that to me was it generally is more affluent guys, gentlemen over the age of 70. And the reason given there is that they are more often risk takers. And they tend to view money and wealth as signs of success. And somehow that just leaves them more open to the potential. So we need to protect ourselves, try to safeguard ourselves where we can.
Yeah, you're right, Peter. And, my dad's, 89 years old as we're recording this show right now. And, thankfully, he's got his wits about him. But, well, you can see how, my mom has hearing issues and how they would become very easy and very susceptible to giving out private information like Medicare numbers, Social Security numbers, dates of birth, and not, just thinking whoever's on the other end of the line is legitimate. So it happens a lot, unfortunately.
Well, let's continue this conversation. Let's have another program where we dive into a few of these additional items. I think that all of them are important for listeners, viewers, for savers and investors, for anyone dealing with money to know about, to be able to watch out for. Chris Mcintire, ladies and gentlemen, an excellent resource, an independent fiduciary advisor here on the program, providing education and giving you the opportunity to apply this information to your individual specific situation. If you'd like to have a conversation, if you'd like a complimentary forensic financial analysis, a review and evaluation, a planning strategy session, pick up the phone and give a call to Mcintire Retirement Services. Offices conveniently located across Northwestern Ohio. 800-868-1194, the number to call. That's 800-868-1194. 800-868-1194. Just for the sake of time, unfortunately, only scratching the surface on today's program and topic, but we'll dive back into this at a later date, ladies and gentlemen. And of course, you can always go to McIntireRetirementServices.com to review the entire library of Chris's content on many specific individual financial topics and get great information there. It's a resource library, McIntireRetirementServices.com, or give Chris a call, 800-868-1194, 800-868-1194. Chris, always appreciate the time, the guidance, the information, and perspective. Thank you.
My pleasure. I hope everybody enjoyed today's show. Stay safe out there, guys, and appreciate you listening this weekend. Thank you.
Visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement.
The content of this radio show is
Be
provided
sure
for
to
informational
subscribe.
purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.